Blackstone, the largest real estate owner in the world, just reported a massive 73% collapse in profits, a troubling sign for both the broader economy and real estate market. With the Wall Street Journal reporting that Blackstone earnings fell after the value of their real estate portfolio dropped, with their net income plummeting from $558 million down to $151 million on the quarter, the second worst performance over the last decade. And ultimately, why this matters to you guys out there is that it's yet another sign of the downturn that's going on in the real estate market and economy. I mean, there's lots of people out there who are trying to pretend like there's no recession, like there's no downturn, yet we have the largest real estate owner in the world with $1 trillion in assets under management reporting a huge collapse in profits and earnings. That's a troubling sign for the future of the economy into 2024, as is the fact that many other financial services companies are reporting poor earnings this year as well. We can see, in addition to Blackstone's income being down 73% year over year, we also have Bank of America being down 56%, Citigroup being down 173%, and JP Morgan down 15%, PNC down 43%, and on average, these financial services firms experiencing a 27% decline in profit year over year, with one of the primary reasons for this decline in income for these companies being higher interest rates. The Federal Reserve rate hike cycle has now pushed the short-term interest rate in America up to almost 5.5%, which has caused interest rates all across the yield curve to increase, whether it be the 10-year Treasury yield or the 30-year fixed mortgage rate. And the problem now for these financial services firms is that their cost of capital is starting to go up in response to these higher interest rates. So they're having to pay more for deposits. They're having to pay more to equity holders when they raise money, which means that there's less of a spread when they then go and make their loans and investments out into the economy, which suggests that things are not as healthy in the economy as a lot of people would want you to believe, particularly people in the stock market, everyone. Because what I thought was especially interesting about this Blackstone earnings report was the fact that their stock price went up in response to them reporting a 73% drop in income. You can see their stock is up to $123 a share. That is almost now matching the highs that was experienced in the bubble in 2021. And what's concerning me here about Blackstone's stock price and the broader stock market is when I go to something called the PE ratio, everyone, which is the price to earnings ratio for the stock. It takes how much the stock is valued at and divides by how much money and income the company makes. Well, Blackstone's PE ratio, according to Google Finance, is 52. Now, that's a very high PE ratio and suggests that Blackstone's stock could be overvalued. Because we have this very funny situation going on right now, everyone, where their stock price, the orange line, has continued to surge up while their income has fallen back down to the long-term norm. So you can see over the last 10 years, there was a very close relationship between Blackstone's income and their stock price, even through 2021 when both boomed, but now they've decoupled. The stock price is way higher than the income. And this is a trend we are seeing everywhere in the stock market right now, everyone. And this is a trend that's very troubling to me because it smells like a bubble. It smells like the valuations of stocks and houses and everything in the economy has decoupled from the fundamentals underlying those valuations, which is predominantly income and earnings. Income and earnings, that's what ultimately tells you what the fundamental value of a company should be. And yet we're in this environment where all of a sudden that doesn't seem to matter as much anymore, with people just blindly speculating that things will improve in the future. And this is something I see happening in the housing market right now as well, everyone, because the housing market is suffering the same issues as the stock market, where the prices of homes have gone up way above the incomes. Because if we look at the last 80 years of what's called the home value to income ratio in America, we can see very clearly that home prices are in a record bubble today. Entering 2024, home value to income ratio of 4.5 based on a home value of $346,000 divided by a median income of $78,000. And what we can see is there's been only a couple other times in history where home prices have traded at this high a multiple. One was in 2006. 2006, the peak of the last bubble before there was a big crash. The other time was in 1954 when the home value to income ratio was at 4.9, and then it dropped significantly over the next couple of years. And so what this says is if you're a home buyer right now looking at buying in the market, you're buying at a point in time where prices are in a massive bubble, roughly 30% overvalued compared to their long-term norms, which suggests that there's a big risk of prices dropping. And what I think is even scarier right now, everyone, is that a lot of people will look at the graph I just showed you and start to make up explanations about how fundamentals don't matter anymore. I'm seeing more and more people say that in the financial sphere, in the real estate sphere. They're starting to say that this time is different, that everything changed after the pandemic, everything changed with all that money printing that the Fed did in 2020 and 2021, and that thus we can't look at historical markers anymore for valuation. And the fact that people are starting to say that is really what's got to get you concerned, because now that people are starting to buy into a this time is different mentality, I mean, that's the sign that something big could be around the corner, that lots of people are buying into the fact that this bubble is actually real and fundamentally supported. And one such company that's buying into that is Blackstone, because Blackstone actually had a big announcement last week. It wasn't just that they reported earnings, they also announced that they bought 40,000 houses across America. That's right, everyone. Blackstone just bought 40,000 homes. And the way they did that was by purchasing the company Tricon Residential, who's a publicly traded Wall Street landlord. Blackstone bought them for $3.5 billion, which means that Tricon, who owns and operates about 38,000 single-family homes, will now be under Blackstone. And so to be clear, from a net perspective, there was no gain in terms of how much either Blackstone or Tricon owns in terms of homes. It was simply a lateral move. Tricon and their portfolio is now under Blackstone. But of course, this is a big deal because Blackstone is the largest commercial real estate owner in America. They manage over $1 trillion in assets. So the fact that they're making a play to get back into the US housing market says that maybe some of these institutional Wall Street landlords do actually want more exposure to the market after taking a break for the last 1 to 2 years. And what I think is super interesting about Blackstone's acquisition of Tricon is where these homes are. Like, what cities is Blackstone now taking over ownership of these houses? Well, according to a recent article by Lance Lambert, who's an expert in terms of tracking these institutional Wall Street owners, he produced some data that showed that the vast majority of the portfolio that Blackstone bought is located in Atlanta, where there's 7,100 homes, in Charlotte, where there's 4,000 homes, in Dallas, where there's 3,000 homes, in Phoenix, where there's 3,000 homes, as well as metros like Tampa, Houston, Indianapolis, and Nashville. So these are the metros where Blackstone is getting more ownership share. And I think what concerns me for Blackstone with this acquisition is that they're buying into housing markets that are very overvalued. I mean, definitively speaking, like Atlanta, Dallas, these are metros where home prices have severely detached from fundamentals. The value to income ratios have skyrocketed, particularly in a market like Atlanta, where home prices are now 32% overvalued compared to their long-term norms. The levels of overvaluation in Atlanta right now are unprecedented and suggest that prices will be dropping into the future if inventory is able to increase enough on the market. And it's a similar situation in a market like Dallas. Home prices in Dallas are 34% overvalued compared to their long-term norms. In fact, Dallas is one of the most overvalued housing markets in America. It's the 5th most overvalued in between Huntsville, Alabama and Ogden, Utah. And so what's Blackstone thinking with this acquisition? I don't totally know, everyone. I think there's a lot of risk inherent into buying into these metros, particularly in the type of neighborhoods that they're buying into as well. The type of neighborhoods that Blackstone is purchasing in are ones that have lower incomes and even higher levels of overvaluation. So I actually wouldn't be surprised if Blackstone actually starts to maybe sell off some of this portfolio that they just purchased, particularly maybe some of the assets that aren't as desirable. Because one thing about this acquisition is that Tricon Residential, some of their portfolio was not performing so well. Like, I went on Zillow and actually tried to look up some of the homes that Tricon Residential owns to see examples of what Blackstone is going to be taking over. And I found some interesting things, folks. Like, for instance, this is a house that Tricon Residential owns, which means that Blackstone's now going to own this house. And they have it for rent for $21.50 a month. But I want you folks to take a look at the rental history here. First, notice how it's been listed 82 days and only has 8 contacts, which means very little interest in this house. But even more concerningly, take a look at this, folks. Tricon bought this house in March 2022 for $500,000, kind of at the peak of the bubble. They then listed it for rent for $2,500 a month. They got that rent for a year, but then tried to relist it again in 2023 and have since had to cut the rent by almost 15%. And they still can't rent it at a rental rate which would only give them about a 3.8% cap rate on their purchase price. And so there's definitely some, let's call it dogs in this portfolio, some assets that aren't doing so well. I wouldn't be surprised if Blackstone maybe sells off some of these lower performing assets, because there's actually a lot of real estate investors right now that are selling. Everyone, this is something that I've been reporting to you guys over the last couple months. We're seeing more and more real estate investors sell off houses, not to other investors, but actually onto the MLS, selling it to regular home buyers like you and me out there. We're seeing more investors start to do this, particularly in a market like Florida, everyone. We're seeing lots of investors bail out of the Florida housing market right now, which is causing the inventory levels, the amount of homes for sale, to spike. With data on Reventure app showing that there's now 113,000 homes for sale in Florida, you can see that inventory level that's above the long-term average. So very important for you guys to pay attention to this. In Florida or in any other state that's acting like this, is that, the inventory during the pandemic was super low. Only 45,000 homes for sale. Now we're up to 113,000. That represents a massive shift in the market, meaning fewer buyers and more sellers, particularly in some of these housing markets like Lakeland, where inventory is now spiked to the highest level on record, as well as Tampa, where inventory is now also above the long-term norms, and even Northport, Sarasota, where inventory is also spiking. And so if the inventory levels are spiking, everyone, and spiking fast, that's a signal that there's going to be a downturn in the market, particularly if home prices are super overvalued. Like if the home value to income ratios are insane compared to their long-term norms, and the inventory is going way up, that's telling you that there's problems ahead, particularly in areas where these investors are selling. The new report from Parcel Labs showing that there's turmoil developing in a market like Tampa, where the investor purchase to sale ratio has flipped from being overwhelmingly positive to now overwhelmingly negative, meaning that there's now more investors selling in Tampa than there are investors buying. A trend which, if it continues, is very likely to push home prices down. You can see here, Parcel Labs also has a great table showing the top 20 markets that have the highest percentage of single-family homes that are rentals. These conceivably could also be areas that could be in the crosshairs of a potential investor sell-off. These would be areas like Memphis, Las Vegas, Jacksonville, Atlanta, and Austin, as well as Tampa, where around 10% of all the homes are rentals. Now, ultimately, folks, Blackstone isn't stupid. They're the largest commercial real estate owner in the world. They're fairly sophisticated. They know all of the data that I'm showing you in this video. So I think maybe the reason that they bought Tricon was the fact that they actually got a pretty good deal on buying Tricon. They bought Tricon at a discount, with Tricon's book value being $3.9 billion. Blackstone bought them for $3.5 billion. So they bought them at about a 12% discount to book value. So I suspect that was part of the deal here. Blackstone got a good deal in the price they paid for Tricon, which gives them some flexibility to work with in the event that values as well as rents go down into the future. And home prices going down into the future, everyone, that's something that I think is going to happen in a lot of different markets in 2024. So if you're a home buyer or a real estate investor, I want you to pay special attention right now, because I'm going to reveal to you a brand new home price forecast score that I'm about to release in the next month on Reventure app. I'm giving you guys a sneak peek right now. I've developed a formula and algorithm that will help you predict where prices are heading in your market over the next year. Let me show you that right now. So into the future on Reventure app, when you guys go there, there's going to be a section called scores. And when you open it up, there's going to be a home price momentum score. And this is a score that goes from 0 to 100. And if the score is below 50, like in the case of Austin, where it's 34, that means is that prices are more likely to drop based on the underlying trends in appreciation, days on the market, mortgage rates, inventory, and price cuts. So these are kind of the categories that we're looking at that are feeding into the home price momentum score. And you can see that this is something that changes over time. So at the peak of the pandemic, the home price momentum score in Austin went to 71, 73. Now it's down to 34, below the long-term average, which is a signal of downward price pressure. Maybe you hold off from buying in Austin. And generally speaking, the areas in blue on this map have downward price pressure, while the areas in red have upward price pressure. And you can see there's some differences. So like if we go up to the Northeast, zoom in, a market like Hartford has a home price score of 63, which means upward price momentum. And that's being driven off the fact that days on the market are still low, pushing prices up. Inventory is still super low, pushing prices up. Price cuts are still low, pushing prices up. And so Hartford's home price momentum score suggests that prices will continue to go up the next 12 months, which means maybe you should buy today if you're a buyer looking in Hartford who's deciding whether you should buy or wait. And the reason I'm super excited about this score is that it's going to be the first of its kind. It's going to be widely available and understandable to users, whether you're a casual home buyer or a sophisticated real estate investor. You're going to be able to, with more confidence, to predict the trends in prices, not only in your city, but also your zip code. Because if we just take a look at a certain city, let's just pick Dallas, you can see there's big differences in the home price forecast depending on where you go. Like Dallas, we have zip codes with a score of like 29 or a score of 30 or even a score of 27, which suggests prices down over the next 12 months. Conversely, there's other areas here that are above 50, right? 57 here in Capel. That means price is more likely to stay stable or increase. And again, it's based off the trends in appreciation, days on the market, mortgage rates, inventory, and seller price cuts. This is ultimately the type of data that a company like Blackstone uses to understand the trends in prices going forward, and it's going to now be available to you. So here's what I would suggest you guys do right now. Go to www.reventure.app and type in whatever city you're looking at buying a house or an investment property in. And for free, start looking at the data on home prices and home price growth in different areas, as well as that data on inventory, everyone. That's going to be super helpful in helping you understand the future direction of prices in your market right now. Just look at these inventory trends in your zip code in your city. And then from there, what I would suggest you do is sign up for a premium plan. The cost is $39 a month and you can cancel at any time. That premium plan is going to get you access to even more high value data, most notably home price overvaluation rate for every zip code in America, so you can see how over or undervalued home prices are in your market. In particular, you want to be very careful. If you're in a city or zip code where home prices are 55% overvalued, you definitely want to be careful buying in that type of location. Conversely, if you're in an area where home prices are undervalued, maybe you do want to buy. Maybe you do want to take the plunge because there will likely be more future appreciation if they're undervalued. Head to Reventure app right now and start there by looking at those data points, and stay tuned over the next month for when I release the home price forecast score. When I do, I'm going to announce it to people on the Reventure app mailing list first, so make sure you go and sign up. www.reventure.app.